You ever been there, just staring at a chart, watching the price do absolutely nothing? Just chopping sideways in a painfully quiet market. It's so frustrating, right? It feels like you're wasting your time. But what if I told you that quiet, that boredom, is actually the market whispering that something huge is right around the corner? Today, we're going to dive deep into how to read those quiet periods and how to trade the explosive moves that almost always follow. So, here's our game plan. First, we're going to understand the market's hidden rhythm. Then, I'll give you the exact tools you need to spot a squeeze before it happens. From there, it's all action. Building a trade plan, learning how to dodge those nasty false breakouts, and looking at some real-world examples. And of course, we'll wrap it up with the one thing that holds this all together, the psychology of patience. All right, the very first thing you've got to get is that markets aren't random. Not at all. They have a pulse. They breathe. They move in these cycles. From really calm and quiet periods to these moments of just high energy and explosive activity. And for a trader, believe me, that calm is every bit as important as the chaos. But why? Why does this even happen? Why does a market that's been snoozing in a tiny range for days or even weeks suddenly wake up and just burst with energy? Well, it's all about the balance, or really, the imbalance between buyers and sellers. That quiet period, that's just a temporary ceasefire, and it never, ever lasts forever. I want you to think of it like a coiled spring. Seriously, when volatility is super low, the market is in what we call a compression phase. It's building up all this potential energy. The price is just stuck, grinding sideways, and traders are getting antsy, waiting for something to happen. That's the spring being coiled tighter and tighter. Volatility expansion? Well, that's the release. That's when some catalyst hits and all that stored up energy is unleashed in one powerful directional move. Okay, so if it's a coiled spring, how do we actually see it before it snaps? Let's get into the toolkit and find the exact signs of a market that is just ready to make a big move. Our number one tool for this is Bollinger Bands. All they are lines drawn around a moving average that get wider when things are volatile and tighter when things are quiet. What we're hunting for is the squeeze. That's when the bands get incredibly narrow, almost pinching the price. This tightening is the dead giveaway. It's the visual proof that the market is storing up energy, coiling that spring for its next big move. Next up, we've got the average true range, or ATR. This little indicator, developed by the legend Wells Wilder, basically just gives us a number. It tells us how much, on average, the price is moving. Now, it won't tell you which direction it's going, just the energy level. So when we see a really low or falling ATR value, that's our numerical confirmation that volatility is drying up and the market is getting tight. All right, so here's your checklist. This is what you're looking for to spot a potential breakout. First, you want to see those Bollinger Bands squeezing tight. Second, you look for the ATR to be at a low point. Third, the price action itself is just stuck in a tight sideways channel. You might also notice that trading volume kind of dries up and different moving averages all start to bunch up and get tangled together. When you see these things aligning, you know that market is primed and ready to go. Okay, we know how to find a market that's ready to pop. Now what? You can't just dive in head first, you need a plan. So let's build a really simple step-by-step framework for how to actually trade these setups. Here's the core plan. It's 4 simple steps. 1. Use that checklist we just made to confirm you're really in a low volatility squeeze. 2. Get your drawing tools out and mark the lines, the ceiling, which is resistance, and the floor, which is support. 3. And listen, this is the hardest part. You wait. You have to wait. Amateurs try to guess which way it'll break. Pros react after it breaks. So we wait for a strong, decisive move outside that range. And finally, step 4, have your orders ready. Know exactly where you're getting in, exactly where your stop loss goes if you're wrong, and where you plan to take your profits. Now let's talk about the single biggest danger with this strategy, the false breakout. This is the classic trap. It's when the price just pokes its head out of the range, gets everyone excited thinking a new trend is starting, and then it snaps right back inside, trapping all the early birds. It's a painful one, but you can learn to manage it. And this quote right here just nails it. The context of the market is everything. If the overall market is just a choppy, directionless mess, these setups are going to fail way more often. You have to be selective. You can't just trade every single squeeze you see. You have to pick your battles when the conditions are just right.
These right here are your non-negotiable rules for survival. Write them down. First, always look for confirmation. A real breakout should explode with a huge surge in volume. Second, place your stop loss intelligently. Put it just on the other side of that old consolidation zone. Third, manage your position size. These moves can be huge, so you might need to trade a little smaller to keep your risk in check. And finally, for the love of all that is holy, do not chase the trade. If you miss that first big candle, just let it go. Chasing a breakout is a surefire way to get hurt.
Okay, theory is great, but let's see what this actually looks like on a real chart. We're going to break down two scenarios, the perfect textbook breakout and then that all too common false breakout trap.
So the ideal trade, the one we all dream about, has a few key ingredients. It starts with that beautiful, clear consolidation and a nice low ATR reading. Then, the breakout itself is a powerful candle, but here's the most important clue, a massive spike in volume. That surge in volume is your confirmation. It tells you the big players, the institutions are jumping in, and that's what really fuels a strong, long-lasting trend.
Now for the trap. In a false breakout, you'll see the price kind of weakly poke above resistance, but the move it lacks conviction. And the key giveaway is almost always weak, pathetic-looking volume. Without that big surge in buying pressure, the move just fizzles out and bam, the price gets slammed right back into the range. This is the classic trap, and checking that volume is the best filter you have to avoid it.
You know, we've covered the what and the how, but I've got to tell you, the single most important factor for success with this strategy, it's not on your chart, it's between your ears. So let's talk about the psychology of a breakout trader. A perfect technical setup is absolutely useless if you don't have the right mindset. You need the patience to sit on your hands for hours, even days, while the market consolidates, fighting that urge to just do something. You need the discipline to wait for your specific signals before you even think about clicking the button. Then, when those signals finally appear, you need the confidence to pull the trigger without hesitating. And if a trade fails, which it will sometimes, you need the emotional control to take that small loss and move on, without letting it mess with your head for the next trade.
So look, if there is just one thing you take away from all of this, let it be this shift in your perspective. Stop seeing quiet, choppy markets as boring or untradeable. From now on, I want you to start seeing them for what they really are, the market coiling a spring, storing up energy, and handing you the setup for your next great trade. And that leaves us with a final question for you to think about. When it comes to actually pulling the trigger, what's your style? Are you the aggressive type, trying to catch the absolute beginning of the move on that very first breakout candle? Or are you a bit more conservative, willing to miss the first part of the move in exchange for waiting for a little more confirmation? You know, there's no single right answer here. It really all comes down to your personal risk tolerance. Something to think about. Thanks for tuning in.